First of all, I'd like to thank you guys for coming out and joining us. It's kind of neat when we get a pretty good turnout. There's only a limitation of 200 people at a time on these webinars, so if in fact we ever get to the point that we approach those levels, it will be first come, first serve. It's only allowing me to do 200 people at a time again. Um, so let's start. We are looking at a hourly chart of the fiber. So let's begin our analysis with the daily. All right. Now, if you note that we have had a recent optimal trade entry unfold on the daily chart in this vicinity here. We were covering this last night in the little webinar I held last night, and I'll kind of real quickly go over what was mentioned last night without all the filler, kind of bring everybody up to speed that wasn't there last night because I didn't record it. So this way it'll be for everyone that missed it last night, you'll be able to see the things I covered. On the daily chart, one of the biggest advantages you can have for determining your trade bias for the day, and I think this is one of the things that many traders struggle with. Should I be buying today or should I be selling today? And forget the fact that you're focused on any session. Your main focus should be what should you be doing as a whole. Are you in a buy program or are you in a sell program? Okay, are we on risk on or risk off? Those factors will be paramount in terms of whether you're going to be successful or not on the long term. And if you've had limited success in terms of finding the directional bias, hopefully tonight you'll be brought up to speed as to how I do it, and you'll be able to go back, and when I do Pro Traders Club reviews, much like I've already warned you in the latest rant I put on baby pips, I have to protect myself. Obviously, I'm not a licensed trade advisor, so when I do these things, there's a certain measure of risk involved to me. So basically what I'm stating to you now is everything I'm sharing with you tonight is totally, absolutely, 100% your risk. I'm asking you to do these things with a demo account. If you believe that they will be profitable and you choose to exercise that with real funds, you do that at your own risk. Okay? So you being here in this room, being a part of this recording in this video and webinar, that is a testament to your acknowledgement and agreement that the risks are yours, and nothing that I'm sharing tonight is indicative of future results. So, okay, I had to get that out of the way. Sorry, guys. All right, now with all that said, you want to look at your daily chart with a bar chart. Okay, and these are all going to be very familiar to you if you went through the videos that I've shared so far. This is the high that we made on the daily chart, and we traded down and we moved up into optimal trade entry. Okay, so basically all I did was zoomed in on what I highlighted just a moment ago. I drew the fib down from this high down to this low, and right in here was the optimal trade entry. Okay, at any time, if I go too fast for you guys, just give me a shout. Say, hey, can you repeat that again, or give me more information, explain it deeper, and I'll go back. And I'm going to be briefly looking at the chat window on the side. So I'd ask you guys not to chat amongst yourselves because I'm looking basically for you to tell me, hey, can you redo that, or can you explain more? Okay, so just try to keep the chatter down, please. If we get people in the room that aren't going to be a part of the webinar, then obviously we'll have to switch to the webinar's chat room. But I'm asking you guys to be supportive of what we're doing here. So just keeping it focused. So anything that posts on the left-hand side, I'm basically looking for air traffic control. Should I be, going back and redoing something, or keeping, the pace going? So I'm going to try to keep this to 90 minutes or less. just because the recording is a little bit daunting after 90 minutes. All right, so we have the optimal trade entry from this high to this low on the daily chart. Again, this is the fiber Euro USD pair. In this vicinity here, we had a 62 and 79% retracement, calling for potential high to come into the market. And since we have the longer term daily chart bias set up for a bearish scenario, even if price does not make it down to the low we pulled a fib from when we draw our optimal trade entry, again, this swing high to this swing low, you want to measure, and this is all part of risk to reward. If we use the low here and pull this up, the potential range, okay, there's 3 sets of numbers if you look close. If I need to zoom in more, unfortunately it's not going to let me do that with MT4. So the text that you're seeing here, and it may be kind of small, but I'm going to read it out to you. It's 13/735 at 735 pips, and it's showing me the price level I'm resting at 1.4700. The middle number basically is telling me and you it's 735 pips potential price swing if we move 100% of the magnitude from this low to where the optimal trade entry fills. Okay, so in other words, if we're looking for a short to get in here on the fiber, we have a potential range, okay, to harvest pips out of over 700 pips. Okay, so if you're going to be a swing trader on a daily chart, that's the type of trades you want to be looking for. And then we'll show in a moment how we can drill down and keep the risk very small, because obviously using optimal trade entry rules, if we're selling it short here, it's 10 pips above this high, right? So that's a lot of pips in terms of risk. So if we just used this, that's 360. I don't ever risk 360 pips. I don't ever risk more than 40, really. I mean, 40's like, if I got to risk 40 pips, I'm really wondering if I should be doing the trade at all. 30 is about right. Sometimes it's 20. I've done risk on trades with as little as 10 pips. I think personally 10 pips should be the absolute minimum, even if you are a scalper, simply because chaos alone and the normal static that you see in price action can very easily whip you out, and it just takes one market maker to pair up an order to gun you out, and you'll be out of the trade. And most of the time what will happen is you'll get stopped out and it'll start moving in your favor, but still close to where you would have gotten it, but you would be like a deer in headlights, scared you won't get back in, and you'll watch it run. And it's very just enchanting to see that type of thing happen. So at least 10 pips, and you'll see tonight how we can get trades that are as low as 10 pips risk. So with that, let's start looking at how we can take advantage of potential 700 pip swing. Now in the videos I talk about different cycles that are very generic in the markets, not just the Forex market. This happens in stocks, commodities, bonds, anything that is tradable. Okay, this phenomenon happens. And this is what we shared last night in helping determine what your directional bias should be for the day. All right, we are in optimal trade entry territory on the daily chart. So what we're looking for is, as price starts to move down, there are several cycles that take place. The first one is range contraction and expansion. And that basically is when you have small ranges, for instance, like in here. Small ranges are a big neon sign saying, hello, watch me closely because we're getting ready to have a large range day. When markets go into a large range cycle, you really want to just put on the brakes, sit back, and wait for things to calm down. Unless you're going to be an ultra intraday scalper trying to take 20 pips out and you're trading with the momentum, that's a totally different story. But for high probability, low risk trades, what I'm going to share with you tonight is you want to be trading right about when these small range days on the daily chart form. You don't have to really be worrying about monitoring the exact ranges from high to low and keeping that type of data. That's not what we're talking about here. It's purely visible. You can just see it on the chart. You don't have to have a whole kinds of logs and records of what the average range and all that, you'll see it. And when we're in large range days, you just basically either trade in the direction of the momentum recently, and we'll go over that. Just bear with me. I'm just giving you some broad scoping ideas as we go into more focused specifics. But basically, the market will move from a cycle of small ranges to large ranges, small ranges to large ranges. And the reason why I ask you not to even be concerned about the actual range of the days, okay, in terms of actual pips, is because, well, for instance, look at this range here. And that's huge. That right there will blow your data out altogether. But this very visibly can be shown as the large range days versus the days before. So we went from smaller ranges to large range and smaller ranges. Large range outside day, okay, big day, and then down, large range day. Reversal day in here, where you get a pause, trades back up to a resistance level in here, okay, and then you get a large range day again. It goes into a small range day, the next day, large range day, and we get a series of large range days. Outside day with the down close, sets up usually a buy signal within the next 3 days, and here you have it here. And we'll go over those types of things. If not tonight, we'll cover this pattern here. But there is a phenomenon that repeats itself. It's very generic, which is range expansion. Range expansion basically is like we have the small range here, then we get a larger range day, then a larger range day, large range day, and then we move into a small range, and then we get large range days going back down here. Then we get a small range, large range, large range. Okay, so basically you want to be looking for your swings in the direction of the long-term time frame. So if we have this optimal trade entry in here, from this point on, we should be focusing on shorts and shorts only for swing trades. In other words, if you're looking for a swing trade of 100 pips or more, okay, that's where your focus should be. Only waiting for opportunities to set up for shorts. Okay. Now, will that mean you'll sit on your hands and let some really outstanding buys go by? Absolutely. But that doesn't mean don't trade at all. What I'm saying is you want to have your mindset set to swing trades with 100 pips or more in magnitude, trading in line with the directional bias for the daily chart. And since we have the optimal trade entry in here, the bias is down. Okay. Now the next phenomenon and cycle that goes through, we will be looking at the relationship to open to close. Okay, on the bar chart, the little tick to the left side of the bar is the opening, and the tick to the right on the bar is referred to as the close. Okay, now the way the markets are engineered and the way they trade, it's very generic. Okay, typically on a large range day, whether it be an up day or down day, typically you have about an 80% likelihood. Now it's a good number. Now think about this, and we're going to get even bigger in terms of probability as we go through tonight. But you have an 80% odds of the high or low seeing the open at either one of those ends. In other words, the range opening for a daily chart, the low of the day typically has either the open or close at or very close to it. Okay, and here we have the close is very close to the high. This here we have the open very close to the high. Down close, it's very close to the low. We have a day that opens relatively close to where it closed the previous day, ran up, and in here we'll talk about how we can look for sell signals that form in this formation here. Then we have a down close, open basically relatively unchanged, trading down with the down close. So the open is very close to the high, close is very close to the low. In other words, on large range days, it's very simply remembered by this. The open and close are at opposite extremes, and typically the open is very close to the high on down days, and opens are very close to the low on up days. Okay, so now think about what we've already covered. If you can determine the longer term time frame and bias, in this case, in this vicinity here, we should be looking for sell signals. Okay, that means when we have a new day, okay, GMT time in Asia, you want to be looking and scouting for a really solid setup that may hint at the London opening providing you a high or low. Now, if we're a bearish scenario like we have here, what that translates to is when we have, the Asian session open, you want to be looking for the open to be trading very close in proximity to what the daily range high on a daily chart, what that high will be for that day. The opening will be very close to it. Okay, so basically you're going to be looking for a sell day. Every single day, your main focus is I'm looking for shorts. Now, once we get through the London session, okay, and we get into the New York Open, which is going to be our main focus tonight, because I believe personally that the New York Open is the absolute easiest market to trade. Easiest one. There's a lot of benefit to having that session, because you have already London in place, Asia's in place, and as long as we haven't fulfilled our average daily range, there's a lot of potential to make serious pips. And it's very low risk in terms of directional bias, because you already have the London high or low in place, and we'll be able to reference that in shortly. So basically what we have here, we have the premise to look for sell signals, okay, and now we have two cycles that go in the market, which is range contraction and range expansion, and open to close relationship, okay. Now, in bearish scenarios, typically you'll have a 75% odds in your favor that, again, each day while we're in a bearish move, the open will be near the high and the close will be near the low, okay. Now, I'm not just making this up because you guys were nice enough to show up tonight, okay. Go back over the videos and the videos that I do with Pro Traders Club, and these are all things that I've already talked about. I'm not making it up. It's nothing new, okay, but these are very generic concepts and they repeat themselves all the time. So here we have our first day when we trade into optimal trade entry. Let me just throw that fib up real quick so we can get it. Okay, here's the optimal trade entry. This is why I'm going to be talking about why the daily chart was suggesting lower prices. Okay, so now let's count the days just with down closes. Okay, down closes. 1, 2, 3. Inside day, small range. Up, up. 4. See how the close is lower here? Up close. 5, 6, 7, 8, 9. Okay, 9 daily ranges. Okay, out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. 9 days out of 16. Okay, with down closes. Now, to neophyte or someone that doesn't pay attention to these types of things, that probably means absolutely nothing to you. But to me, that right there evens the playing field, because this is what institutions are looking for. They want to see the momentum, because they are momentum traders. They will be in moves going down. Okay, so when they allow the engineering to take price up, like here, okay, they're the ones, the smart money, they're the ones selling between where the close is and that high. They're the ones doing that selling in there. The public, street money, okay, and neophytes, they're the ones in here buying all this up, and they'll allow all that. They'll pair orders as price goes up, 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 up. Okay, and all in here, they go into a distribution phase, and you'll see all kinds of smart money divergences on your hourly chart, your 15-minute chart, your 5-minute chart. They'll be screaming right in here, and all of a sudden, we get into a new day at 2300 GMT. Note that on your charts. That's when you have a significant shift in flows, and study that, and you'll start seeing this phenomenon take place where they all slam it down. Okay, so in here you'll see this is a trending day. You're going to be looking for opportunities to use your optimal trade entry to get in sync with the daily range direction. That means looking for your London Open to provide a turtle soup sell or a optimal trade entry at around 3 a.m. Typically, if you look at London, you'll always really see something give you a high or low right at 3 o'clock in the morning, New York time. Hopefully you guys know that by now. That's just like a sweet spot in the time of day. That's like, it happens all the time. It's so consistent. So if you are a London trader and you like the London Open session, it works for you. Really be paying attention to that 3 o'clock in the morning time frame for setups. It really it's very consistent. But getting back to what we're discussing tonight here, so we have this premise of down days, okay, overall, suggesting we should be focusing on shorts. So let's start moving down to a 4-hour chart. And let's zoom out just a little bit. Okay. Now we're going to start seeing how the markets have dynamic support and resistance levels, and you can start seeing how the flows start building fractals. Okay. You should be able to see this is a very generic price pattern, head and shoulders. That should be jumping off at the page at you. But it happens to happen right at, here's that London, optimal trade entry pattern. All we're doing now is starting to drill in, and we'll start seeing shorter term fractals, swing highs and swing lows. And by doing this is how we do a top-down analysis. And again, real quick, I just want to throw this up so we don't lose anybody. This is the same swing. All we're doing is we're bringing it up on a 4-hour chart. See, here's that optimal trade entry in here. Okay. So now looking at this, we can start seeing now much more price information. Okay. And this is what we discussed last night. Once you have a determination on the higher time frame, in this case we were looking for shorts. Okay. Price had moved down, traded up, slammed down, bear flag. Okay, when you have the long-term directional bias right, all of a sudden all of your price patterns, your analysis concepts for short selling works perfectly. Everything dovetails nicely. Okay, every swing high and low, you want to reference that from your 4-hour down. Okay, so you can see here this is swing low, there's a swing high, swing high, swing high, swing low, swing high, swing low, swing low, swing low, swing high. And you have to start studying the chart in terms of price swings. Okay, and if this hadn't already jumped out at you, this is how if you would have missed this on these price levels in here, okay, how could you get yourself in sync with this move going down and catching this one? Okay, because this is where everybody realized what was going on. Funds dogpiled on this because now flows had shifted. Okay, and all of the stops resting underneath this low, they wanted to at least target that, and now they knew everything was primed and engineered to go lower. Well, this swing high to this swing low, what's this? That's your optimal trade entry on a 4-hour. Okay, so now we are using the higher time frame daily. Okay, price trades up in here, right in this vicinity here. Okay, this is how you can start drilling down into really, really, really low risk, high probability trades, because now you're looking at a likelihood of catching really big ranges because you're trading in the direction of the daily time frame. You are in sync with market flow because all of the swing lows have been penetrated. This is the most recent swing high on the 4-hour, so this right here would still have a bearish market flow. I know we haven't talked about that lately, but you guys should be still paying attention to that. And also we traded up into, see this swing low here? This was resistance. Okay, if you look at where price is, essentially it's at the institutional 80 level. Okay, so we're going to leave that level in there. We're going to highlight that little area, and we'll come back to that in a moment. Okay, and now looking at a 4-hour, let's drill in just a little bit tighter and look at that same phenomenon we just discussed about the range cycles and open to low and high relationships where the close and high is. I'm sorry, the close and the open is for the bars. Okay, we have a down close here. We have 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 of these 4-hour bars were all down closes. Okay. Once in a while you'll get these little up closes. Okay, so this is how you could have very easily scalped a long in here if it was time and price theory lined up. Okay, but you see how getting yourself in sync with the higher time frame, daily chart, and with the daily market flow being down, selling short in here, or looking for opportunities while price was moving down in the direction of the momentum, that's where the money's made. Okay, now we're going to go and we're going to drill down even tighter to a 1-hour chart, and all this will make sense is on this building a foundation. Okay, just give me some time. All right, here's that that same high we noted. Okay, now if you take this and consider, say you missed this one. Okay, you missed this move here. This swing high on a 4-hour, okay, hadn't been penetrated. So market structure, okay, market structure, not market flow, market structure still suggests lower prices. Okay, you could take your fib, pull it from this high down to this low here. Look how much time price spent in here. Now, I'll grant that yes, we had several little stabs above it. Okay, this is your 79% retracement level. But look how much time it worked within this area here. This was all a distribution phase here. Okay, so there was a lot of selling and engineering for price to go lower. They were just allowing the street money to buy, and then they put the brakes on it and slammed it down. Now, you're probably saying, okay, well, wait a minute. Isn't this an optimal trade entry buy? Yes. But you got to think in terms, now you're trading against the daily flow. Okay, the momentum on the daily chart. It's a higher time frame. So by doing that, you got to be really, really nimble. Okay, so by doing that type of trading, using this high, I'm sorry, this low to this high in here, generally swing projection concepts that I teach. Okay, here's the 127 extension. You can try to reach for that if you buy these. If you're trading counter trend, okay, and this is to me how you would refer to it as counter trend. If the daily flows are so one-sided like this clearly has been recently, and we called it in advance, it's not like we talked about it after it happened. You're trading against this daily momentum or higher time frame. I don't want to be trading for the 127 or 162 extensions in that scenario. All I'm going to do is I'm going to take profit at the high. In other words, if this is the optimal trade entry, when price trades up to this level, I'm out. I'm done. I'm not worrying about all this. This will be no problem to me leaving it on the table. But on the flip side of that, if I'm trading swing trading and I'm trading in line with the daily momentum, I will take the highs from here, swing up here. Here's the 162 extension. I will absolutely hold for something like that. And if price structure still suggests that we have everything in line, using the bodies of the candles here, okay, there's your low on the 127, and if you just use the 50% range here, 100% of that move swung down, and there's all your opportunity to get out here at the 141.60 level. Okay, so hopefully that makes sense. If not, it will as we go along and show more examples of it. Now we're going to look at this little area here on a 15-minute chart. Okay, here's that fractal low we were talking about on the higher time frame, and as price traded up to that, that would be a reasonable expectation for resistance, trading at the 144.80 level. Okay, this price pattern right in here is what I refer to as turtle soup. Okay, so in other words, if we are anticipating expectations for lower prices, okay, when price trades above this high here at a known or expected resistance level, okay, you're going to sell right in here on also the heels of, take that out for a moment, on the heels of this high being penetrated. Okay, but remember, we pulled a fib from this high to this low, so we had several overlapping events to imply. See where the optimal trade entry unfolds right there at a key level 144.80. Okay, so we can use now the turtle soup entry pattern to get short. Okay, using the same concept of risk management. On optimal trade entry, the stop would have to be above here. So let's measure that. And that's going to eyeball it just for the sake of keeping things moving along. Okay, so now we're talking about a stop of 70 pips. Okay, still too much for me, too much. So what do we do? Do we let the trade go?
Nope.
Let's drill down and look at that same region there on a 5-minute chart. Price trades up into this region here. Okay, now you can drill down to these levels, creating a turtle soup pattern. Okay, so now we can look at, I should have used this one here, and then we're going to use this one here, this high, as price trades up to it. You're going to sell right above that. Okay, and then we can now use our standard 30 pip stop. Okay, now watch what happens when we do that. Okay, selling it right above here. You're going to sell it right into this bold face bullish move, which I know may be scary. Selling it, let's say we use 90 as a small number entry. $30 pips above this trade here. Okay, we're trading at the 145.20 institutional level. Okay, so that's one way we could take advantage of that opportunity using all of our tools and confluences of technicals. Now I'm going to ask you if this has this been, have I moved too fast for you? I mean, everybody's still on the same page, because I'm going to start getting a little bit more involved here. All I want to know is anybody that hasn't got what I said so far. Okay, Polka. Why am I suggesting 90 as an entry? Is that what you're asking? Okay, reason why it's a good entry is because, right, we just trimmed the trade down to a 30 pip stop. Okay, here we have the optimal trade entry. Okay, these levels are based on a higher time frame. Okay, here's, see the 15-minute chart? Here's the high, pull down to the low. These levels is 62 and 79% retracement level. So we're looking for a sell signal to unfold in here. Okay, Now we drill down to a 5-minute chart, because even though we see a turtle soup pattern likely to set up as it trades above this high, okay? In other words, we're not looking to trade long in here simply because it's been moving up. The higher time frames have suggested it's going to move lower. So we want to try to trade all of our trades intraday and trading session wise with that premise in mind. Yeah, just give me a few more minutes. I was getting to that kill zone. But I wanted to have you all on the same page as to why we would expect price to go down here anyway. By having used the 15-minute chart to zero in on a optimal trade entry region when to anticipate a price swing or optimal trade entry or turtle soup pattern to get us in line with the direction of the daily chart. That's what we're looking for with a 5-minute chart. Okay, and by moving over to that same spot, time and price, okay, we are looking at price making higher highs in here, stabbing above it. The reason why I used 90 is because, number one, here is the high here. Okay, you want to be selling above this high. As the price trades above it, you want to sell. Part of optimal trade entry concept is you don't want to be selling when the move's already going down. Whenever you enter a short, the ideal time is when you have a move moving away from, or in this case, since we're looking for a short, you want to be entering as the market is moving up. That's the surest way to know if you have a good trade, if you have a good fill, and it's the fastest way to recoup the spread. And I see a lot of guys struggling and worrying about, I'm paying 3 pips for the euro. Well, I pay 3 pips for the euro, and I don't mind doing it, because when I take a trade, very quickly, if my trade's profitable, I'll know real quick, and the spread will be covered relatively quick, and I'll move closer to profit faster. Okay, so with that same premise in mind, if we know this high here, in other words, the chart would look like this. Okay, so we're entering here. Here's the 62% retracement level, and the 79% retracement level. So we're already in the optimal trade entry region to go short. Well, looking at the levels we're at, you could very easily, okay, just get in here and try to get short at 80. If you felt confident because we went above this high here, that's fine. I'm not going to say that you couldn't have done that. But we're going to look at a kill zone in addition to this, okay? So now we're going to trade above that high here, okay? A nice round number is 44.90. The figure is right above this, but we're on a daily chart trending lower. We've now had a move trading up, okay, which is engineering another magnitude swing going lower. Okay, and we've already classified a potential 700 pips of a move that could happen and unfold. Not that it's going to happen in one day, guys, but looking at the daily chart, we already covered that's why we anticipate lower prices, even if it just sticks down to the old low we drew the fib from. Turtle soup on this time frame, getting us short, we are getting closer to that 79% retracement level, which this right here, if it ever trades to 79%, on any optimal trade entry, if you can get that level, that price, that's the one you want to try to get. But if you always expect to get that level, you're going to miss a lot of opportunities, because you'll see many times it gets right in the middle portion of this 62 and 79%, that little sweet spot we talk about. And what will happen is that's where all the pairing of orders happen, and then they start to move it away pretty quick. But generally, I will always buy or sell the 79% retracement level, because it's just that good, and it's very manageable in terms of risk, because the higher low that we drew the fib from for the optimal trade entry generally works out real well in terms of pips for the trade or the time frame I'm using. So, but basically, if you get a level that converges with the 62 on other types of trading patterns, like a pivot or key support and resistance level, you can get short just on the 62. But using this example, we were looking for price to trade into the optimal trade entry region, and we had this high here, so we want to be selling above this high. And they're going to be looking to try to get anybody that's a breakout artist. They'll be buying on a breakout. Like, they'll see this as a bull flag. Okay, that might look like a bull flag to some. Okay, remember I said earlier when we had the directional bias correct, all of the chart patterns in your technical analysis looking for shorts works perfectly. Well, we're trading in a dynamic that is suggesting lower prices. So just because it looks like a bull flag here, someone might say, okay, here's the low of that, and here's the high. So if I buy it in here, I could see a repeat of this move here added to this low, and it's going to go to 45.35. And then all of a sudden, they put their buy order above here because they want to buy the breakout, because they want to make sure it's moving in a direction. So their buy orders are sitting right above this high here, or at 144.90. So market makers will take it up there, pair orders right there. Sure, they'll give you a buy order. You can buy it because they're going to sell the other side of it. And that's what I do. I do the same thing that the smart money's doing. I want to get in when I got people with less understanding taking the other side of my trade. I will get an excellent fill, and I know what's going to happen. The phenomenon is going to be when price gets up there. If I sell right into that, the smart money is going to retrace and retract or reject that level very quickly. So it's going to cover my spread very fast, and I'll know I have a profitable trade. I'm trading in the direction that's opposite to where I want to go in the trade. So that's what makes it optimal trade entry. Not the optimal trade entry pattern, but the concept of optimal trade entry. If you go back to my original thread, you'll see that you're buying bearish bold-faced red candles, and you're selling short bullish bold-faced candles. Okay, and it's kind of scary when you first start doing it, but the only way you're going to learn how to do that is if you continuously do it for months. I'm not saying get out there with a demo account for 20 days and all of a sudden you're going to be able to do this. You need to do it for months, because it takes a huge paradigm shift in your thinking, because as traders we want to know it's moving in the direction we're trying to buy it. We want to see it moving a little bit. We want to feel safe. But generally, then you end up chasing the market and you end up getting bit. So that's just one little thing I would like to throw out there, because it's very important. It's one of the essential tenets to how I get really good fills. And sometimes it just looks too perfect. It looks too good when I put these Pro Traders clubs up, and they're like, man, come on, the guy's buying right at the high. I'm sorry, buying right at the low and selling real close to the high. If you do the things I've suggested, okay, in a demo account and practice it, it's the same thing you can do. It's the same thing. It just is very generic things that happen all the time, and certain times of the day you expect these things to unfold this way, and only until you see it happening and you build confidence and you begin to anticipate these things, fear subsides. You won't have any emotional response to putting on a trade. It'll just be like the same thing you do all the time. If you have a job right now, you know you're going to get up at the same time every day. You're going to take a shower, or you're not going to take a shower. You're going to drink coffee, eat breakfast. You got a routine. You know what time you're going to expect to get there. If traffic doesn't, become an issue, you know what to expect. You're not shell shocked simply because the alarm goes off and you got to go to work. You know what's going to happen. You're dreading it because you don't want to be there, but you know what's going to happen. So there's no fear in that. There's no emotional response except for the fact you don't want to be there. Well, you want your trading to be like that. You want to be really predictable, and this is the way you do it. You look at specific times of the day, specific price patterns, and if you can see these things on the higher time frames and drill down, you can see how the market makers do these things all the time, and they fake everybody out. They think, oh, what's going to go up above 4,500? That is the core concept to top-down analysis. Okay, you want to have as many confluences of events to agree with the longer-term time frame. Because let's just say you're wrong on the higher time frame. Okay, let's just say you're wrong. You think that price was going to go higher on the daily chart. If you have more confluences suggesting that it's going to go down, you may just still catch an intraday move going lower. Okay, and by using optimal trade entry rules and taking first profit at 20 pips or 30 pips, or at 0 or 100% of that fib level, You're still going to be profitable, but still wrong. And that's what I'm trying to teach everyone. You don't have to be right. Okay, you just need to be profitable. You may have a bullish outlook on the daily chart and buying, but if you're only catching a portion of the move and it reverses strongly on you, it may hurt your pride and it may scare you thinking, man, if I would have held this longer, I would have, lost. But you're still going to be profitable. That's what you need to. The mindset needs to be, I don't need to be right. I don't have to have a 100% accuracy. I don't have to have myself on a forum saying it's going to go to XYZ and it's going to get there in 3 days and everybody's going to think I'm great about doing that. It doesn't matter. That does not matter whatsoever. It doesn't matter at all. You want to have the longer term time frame premise in mind. Okay, it's a premise. It's not a guarantee. And if you look for things to line up, your tools, and I'm gonna be very blunt with you. Your tools, if you use them the right way, it will keep you out of trades. It won't line up several things with an optimal trade entry, okay, in the wrong direction. That's what makes this pattern so good because the funds use it. Okay, so they use it to key off of the other side or the street money. They want everyone to see a specific type of thing happening on the chart. Okay, they want to see people throw money in there and order flows start building up, and they build a fractal on that, and then it takes off. I'll show you some examples of what I mean by that, and it'll further amplify that. But going back to here, the reason why I used 90 because basically it was above here, this high here. It's a nice round number, and I may not get the 79% retracement level. I may not get the figure. So 44.90, I just threw that out there as an idea. So getting short here on a turtle soup short in the realm of an optimal trade entry on the 15-minute chart in the direction of the daily chart. Okay, now let's look at what time of day is that. Any ideas what time of day that is? Mm-mm. This is 1600 GMT. What time is that? There you go. London close. London close. Okay. Sorry. I like to keep my. I don't know if I'm just blessed with good eyesight, but I like to keep my text real small. Um, so I apologize for that, guys. Here is New York. Okay. This is New York opening. All right. London close. Basically 11 a.m. All right. Now we have London close time window, turtle soup, even a second opportunity to get in it here, in an optimal trade entry. So we have time of day in the direction of the market move on the daily higher time frame. Okay, so now we can look to go short in here. Okay. I didn't bring them up yet. I'm showing you pure price action, time and price theory. If we pull up pivots, we're trading in a mid pivot level on GMT. And if we use New York pivots and R1. Okay, so we have this. What are we in the buy zone or are we in the sell zone? Pivot zone basis only. Are we in the buy zone or sell zone? Exactly, exactly. Okay, so see how many things are now lining up? We have time of day. We have time and price theory. Okay, price is meeting in a reasonable expected sell region on a higher time frame, a 15-minute chart, optimal trade entry. We are at an institutional level. Okay, we have turtle soup right in what would be optimal trade entry, trading at R1 in the sell zone, and we've already ran out from New York. So London close time frame, we can look for what to happen? Price to trade back into its range. Okay, here is the beginning of the day. We're trading here. To move back into its range would be going down, and that's what you see here. Okay, so let's take all that back off. That's how you break the market down to see that. So now let's talk about how we can trade the New York Open with all those things in mind. Okay, let's go back to the daily chart. Okay, we have we have the optimal trade entry in here on the daily chart. Again, we're pulling the high down to the low, and here's your 79 and 62% region up here. So we're going to use June 8th, June 9th, and June 10th. Okay, we're not going to look past all this. Okay, we're just going to look and see, okay, if we're going to see a sell-off into optimal trade entry, because it could very easily come down here and find support at these highs in here, and then bounce higher and shoot up higher, and then the optimal trade entry on the daily chart becomes negated. But we'll use the 8th, 9th, and the 10th. So let's go down to a 5-minute chart. And the reason why I'm using a 5-minute chart because we're going to be looking at the data for the whole day and zero in on specific openings and closings of the day. Okay, so we're looking at June 8th, 9th, and 10th. Okay, put our levels up here. This is midnight, New York time. And this, I just want to block off the days first, guys. Just give me a sec. I apologize if you hear my smallest son. He's very animated tonight. He's just outside the door. He's trying to get in here. So yeah, I am a dad on top of a forex trader that never gets sleep. Okay, so ready? Good, good, good. All right. Okay, we are going to look at the 8th. And all right, here is midnight going into the 8th New York time, the 9th at midnight New York time, and here is New York midnight on the 10th. Okay, so we are trading away from optimal trade entry on the higher time frame up in this vicinity here. And now we're going to take a look at the kill zones for New York Open. Okay, and change this. Guys, again, I apologize. I meant to have some of these charts already prepared to help things move along, but if you're just getting here, I had an auto accident actually right before I signed on. It was minor, it was a fender bender, but it's just still a pain. Okay, and we'll use there. Okay, so now looking at this window of opportunity on the New York Open. New York Open, okay? Again, this red line here denotes midnight time on New York, my local time. All right, so now looking at this, okay, we have a higher time frame daily suggesting lower prices. So using this low here on this swing, we're in optimal trend entry here, okay? So going into New York, I'm sorry, to London, we would expect prices to sell off. Then we see price bounce up into here, okay? Once price slid down from this level, okay, any bounce up, as soon as it starts to bounce up, we want to pull our fibs down, okay, and you see another optimal trade entry right in here. This is how you would have traded the London Open, okay? Higher time frame suggesting lower, multiple nesting optimal trade entries right in here, and let's take this off for now. So now we have price suggesting lower in London, okay? So now let's go back to the beginning of what we have already covered. Daily time frame, we're suggesting lower prices based on the optimal trade entry, price structure, and trend change. We have the range cycle that we look for. We're looking for daily bars. In other words, the basis on time frame daily. The opening should be at the high of the day, and the close should be near the low of the day. Okay, so now with that in mind, we're trading in a new portion of London. Okay, so we should be looking for the high. Remember, we're looking for lower closes on the daily chart. The high should be very close to where it opens. So we made the high here at London. Market trades down right into New York Open. So if we're trading down into New York Open will give us an opportunity to do what? Any guesses what New York Open should suggest if we have a market structure and trend directional bias on the higher time frame like daily? If we're looking for down, what should we be looking for? Exactly, because we want to see price move even lower going into late New York time. Okay, late New York, generally about 1800 hours on GMT. Exactly. Okay, so now let's look at that, and we'll have to zoom in a little bit here. Give me a second. All right, and I'm going to move from bars to candle. All right, so now we have. Now this is where it's going to get a little tricky for us, because I know you guys are so used to crystal clear, perfect, optimal trade entries. Okay, so we have a high here, swing high. Pull it down to this low here. All right. Now this is what you would have saw in that session. Okay. Looking for a buy zone or a pivot zone trade, and simply because we went down to S1 and we went down to the figure, it's a buy. Well, it can be a buy if you're scalping, okay, but if you really want the high probability of making money because you're trading in the direction of the longer term time frame, this means nothing that you're in the buy zone on pivots. It means absolutely nothing. Remember, the pivots can reverse their roles. Okay, so if we're in, here is the daily pivot, central pivot. Optimal trade entry on S1 here to go for a long. Yes, that is a scalp because you're trading counter trend, right? But this is why I want you to think in terms of higher time frames, because this is how institutional traders, banks, they're all looking for market flows to pull the market lower. Okay, so yeah, I'm going to tell you, you can make money. You can make money doing counter trend trading, but you really want to be catching this move here, and that's what we're detailing, that type of magnitude of move. Because if you remember, if you just look at the, the trades I post, they're pretty big. I mean, I'm not trying to brag, but I'm catching some pretty big, significant moves. And this is why and how I do it. And if you follow these things, you're going to be able to do the same thing if you put practice into it. So here's the significant swing into New York. Okay. Optimal trade entry in here. Okay. You would be looking to go short. Appreciate that. Thank you. If you pull the fib from this high here and this low here, because we're trading into the New York Open, okay, you would be looking to go short in this vicinity here. All right. Now the way optimal trade entry works is you want to use at least 10 pips above the high you draw down from, and what that would look like. Okay. 146.45. Okay. Which happens to be the 127 extension on here. That's for another lesson. I wish it wouldn't have had that on here, because you're going to probably be thinking to yourself, well, it's something to that. And it is, but not for tonight. 10 pips above that is where your stop would be, and you never would have gotten taken out of the market. Also note that we always have to have our reaction levels keyed in. Here's a low, low here, and our stop would have been above that resistance level also. So this is your short, and by doing this like that, going short, trading the New York Open, what you've done is essentially you have allowed the London Open session to provide you the information you need as a day trader trading the session on the New York Open. London made what? The high of the day. Okay, we still have battery left in the day. Remember, everything on a daily time frame, 24 hours of trading, you have a battery life of potential move. And by doing this, looking at price for a 24-hour period, session by session by session, we know by 1800 hours, the battery life is generally used up. It's done. You know what? I probably should have had 1800 hours noted on the chart, so let me do that. Sorry. Okay, so there's 1800 hours right here. All right. You want to be out of your trades by then, unless you're in a really long-term position trade. 1800 hours is the plug. You pull it, you get out. Okay, so there's another nugget for you. Keep that in your notebook. So here's the London session, creating the high of the day. Trades down. We go into a consolidation phase. You see that? This might look like an inverted head and shoulders. 1800 GMT, yes. Now going short here, stop above here. All right, getting short. Now we can use our swing projections. You can use our swing projections like we normally would. Okay, and now here's the 162 extension. Notice how if you were just a pivot trader and looking to go short from S1, if you were smart enough to do so, you never would have got down to S2. All right, it never would have got there. Now, you're going to see what we teach on the London close. Right, exactly. All the liquidity is drying up. The New York traders are closing the shop for the day. Unless it's an extremely severe trending day and there's news event driven, 1800 hours. Just note it on your chart and just study it. I mean, you'll see some little blips beyond that time frame, obviously, but you just want to be out of the market because it gets real thin. And if a bank comes in and does a large block of something, you can get hurt. And it's been known to happen like that. So you just want to be out. if you're a day trader, unless you're a long-term position trader. Okay, so here is the end of New York Open. Okay, and let's just move our line over to, what time frame is that? You guys should be screaming this one. It's what everybody's been talking about. London close, exactly. Now, here is your classic setup. Okay, classic setup. We have a down day. It's been trading lower. Okay, market makes a low, and it bounces right at the London close time frame, trades back down. What do you think this is going to be when I draw a fib on it? Perfect. Now you're getting it. So now we have a low to high. Bingo. Isn't that amazing how these things line up like that? It's like clockwork, isn't it? Now, if you want to be a London close trader and you have your setup like this, you have a classic day where it trades back into the daily range. London close scalp when you fulfill the role, or not the role, but the parameters that is used for London close. Obviously, we fulfilled our average daily range in here, and also we traded into the time zone. We created an optimal trade entry in here, and basically, if you take the high of the day in this area here, pull down to the low at that time frame. Okay, remember our rules. You trade the London close, take first profit at here, and in 38% of the day, or 38% of the range, you want to cover. Get out of the move. And here's your 38% retracement level, and there's your bingo. You want to get out of that and be done, be satisfied with it, and then all of a sudden you see it resume and trade back down. Okay, so if you are an ultra, exactly, double tap. If you have multiple accounts, like I do, you can have your position trade on here, and while you would anticipate price to trade up against your position that you went short in here, or if you were fortunate enough to catch the London Open session or in here, you can trade long counter trend at London close when all of the UK traders are basically closing their day. They're going home. They're just not trading anymore. At the same time where New York traders are going to go to lunch. Okay, if you look at the equities market around 11 o'clock to 1 o'clock in the afternoon, that's the doldrums, okay, for North America. And anything that has happened prior to that, which is a down day, okay, profit taking will come in, position traders will look to square their positions up in here, and liquidity will dry up, and you'll allow the market makers to pair orders up to give one more surge going lower or consolidate into the day. All right, so now watch how this works. Yes, you caught the London close trade, and you took your profit exactly how it should have been at the 38% retracement level of full day's range. I probably shouldn't do this one. I know if I do this one, it's going to open up all kinds of questions. Let me just do it. I got to do it. I won't be satisfied unless I do it. All right, do you see that? Here is your fib pull down, optimal trade entry, 62% retracement level, right at London close fulfillment, and we are still within, the trend direction of the day. And you can catch this move trading back down to this low here. And there's several opportunities you could have traded intraday and scalped this day. So did any of that make sense so far? Did I introduce anything new? I mean, this is all the same things that's been put on the internet for months now. I mean, if you go to the thread and videos, it's there. Me personally, how do I determine when I get an optimal trade entry? Or are you asking in general how you should? Um, um, Basically, here's the easiest way I can tell you. Okay, and you're not going to get the best fills all the time, but you're going to catch the moves when it's profitable. If you take the spread of whatever pair you're trading, okay, add that to whatever the 62% retracement level is. So if you're shorting, you want to add the spread of the pair you're trading, and let's just use, for instance, the fiber, okay? If the 62% retracement level is 146.20, put your order to sell on a limit at 146.23 in a demo account. For risk disclosure's sake, I have to tell you this. I'm not telling you to risk real money here, sorry. But on a demo account, you can test this theory out at 146.23 limit, selling it there. And then as you get more experience doing it, you'll develop a feel for when it's more appropriate to go higher into that sweet spot. But just prepare yourself for sometimes not catching the move. I mean, it won't go up there that far. In this case, it gives you the 62% retracement level, and then just stabbed above it just a little bit more. But it didn't give you much more of an opportunity than that. And again, this is 5 minutes, so if you weren't right there in 5 minutes and didn't have your order in, you didn't catch it. But by using the pivots. Now also, look, see guys, this is what I'm talking about. We're at S1. We're in the buy zone. Granted, this could have been look like, okay, optimal trade entry, London close. It's probably going to keep on going up. No, the higher time frame is what's pulling it lower. And this is how you could have used this opportunity to get short if you missed the London close. I'm sorry, London open, New York open, London close trade in here sets up another amplitude wave to go lower into the close of the day, 1800 hours. Okay, that was how we use the concepts on the 8th. Look at that monster. Good grief. Right, the average daily range, okay, you can refer to the average daily range on the New York Open in terms of risk to ratio, risk to reward ratio. In other words, if you have fulfilled the daily range in London Open into New York Open, really strongly consider scaling back your leverage and not really trying to push too much. And you can still take the trade, but I wouldn't risk 2% on a day like that. Just risk one, maybe a half a percent, one half of 1%, because there's a lot of people that follow these average daily range figures, and they'll be less inclined to continue, even if the daily time frame is suggesting lower prices like we were seeing here. You may not get, well, you certainly may not get this type of thing here, but you have things stacked against you to have momentum move in your favor. So while it is important and something that I reference in New York, if you have the directional bias on the higher time frame in sync with what you're doing in New York Open, and you, for instance, like if we're shorting the market because the higher time frames are suggesting lower prices, London puts in the high at New York, you have a loaded deal. It's going to go down. But really consider strongly taking your 70% of your position off at the fib low. In other words, like using this example that we used here, pulling this fib down from this high here to this low. If we had fulfilled the ADR like up here, I would really consider taking 70% off when it gets down to that level here. And yes, you only have 30% catching that, but good grief, man. I mean, you're catching, still a good chunk of pips in here, just scalping. I mean, that's what I really want to get your attention. When I say scalp, I'm not talking about 5 pips. I mean, I see all these guys on baby pips, and I'm not trying to make fun of anybody. That's not what I mean. Scalping to me is taking 10, 15, 20 pips. Okay, if you're doing anything less than 10 pips, you're skimming. Okay, you're skimming. That is not trading. That is gambling. Just static alone can crush you. Longer term, I'm telling you, the odds are so far against you doing anything with this like that. just don't do it. Just honestly, that's the best piece of advice I can give you is just don't trade like that. If you can't catch at least 15 to 20 pips in that move, don't trade it. And this is the easiest way to determine it. If you see what looks like an optimal trade entry, and from where you try to get in at to the low it pulls from, there's 32 pips. Who in here is not going to be happy with getting 32 pips? I think anybody in here would take 32 pips. I mean, if I mailed 32 pips in value to everybody in the room, you'd take it. You wouldn't say no. So if you're trading, 30 pips, if you do that once a week, that's astronomical. If you manage your money right, that's huge, man. That's huge. You don't need to catch these 100 pip moves, okay, to build wealth. It helps, and you should be looking for it. But I don't want you thinking that you have to do, these massive swings to be successful in this. You don't need that. If you just find one of these once a week, that's all you need. That's all you need. I guarantee you in 4 years, if you manage your money right, and I'm not going to put it out there because everybody say, well, ICT said you could be a millionaire in 4 years. No, I'm not saying that. I'm saying someone with the right mindset using these tools with sound money management and compounding your profits. Don't take much out. Don't live off your account when it gets to $10,000. Let it build. You'd be surprised how fast this thing grows, and you don't need a whole lot to do it. So basically, the answer, I went around the block to give you this answer. Basically, ADR on the New York Open, it's something I look at, but if I'm trading in the direction of the dynamic that's on the higher time frame, if I'm expecting a bounce, even a bounce that's counter trend on the daily, I will discard the ADR and still hold beyond that move, but I'll still consider taking off 70% of the move when it gets to 100% of the fib I use for my optimal trade entry. So hopefully that answers your question. All right, here is news. Okay, here is New York Open. And let's pull up London Open. And right there. And let's put the other side of New York Open on. Okay. Here is a day where you have everything going for you. You have a London high. Price trades down. Okay. But where do you see a signal form to get you an opportunity to get short? Do you see anything on there? That, well, no, the real answer was there is no New York session trade here. That's the answer. Okay? This is a day where you don't do anything. You let the day go by. Okay? Especially, honestly, I'm going to be honest with you, man. If you're looking at this and you say, man, let me get in here and trade, you are a gambler. You're a gambler. That right there, that just, if I'm not in that, I'm getting the hell out of the way. I don't want to be in front of that freight train. You will get mauled, destroyed, and you're not going to make money in that. Okay, so the answer to this is you just let it go. These are one of those things where you just allow the market to say, you know what? It moved a lot. I didn't take anything out of it unless you were in London Open. Okay, you just let it go, and you didn't lose anything, and your ego can't be hurt because you didn't take a trade and lose money or miss it because there was nothing there. See, it consolidated. That's what I'm trying to tell you guys. If you trust the tools and learn how to use them, there was nothing to get you short in here. And let's assume that you did. It didn't do anything. You see what I'm saying? It consolidated into the end of the day. Here is 1,800 hours in here. All we did was move sideways. Okay? So that day's a scratch. So basically, the lion's portion of the move was put in London Open. Okay, so you had nothing else to do the rest of the day. It just consolidated into New York afternoon. All right, moving into our last day for our case study. Okay, sorry. We are dropping in the New York midnight time frames here. We are putting in now the London Open. And that is right here. And now we're going to put in the New York Open right here. And now we're going to look, and again, same premise in mind, the daily chart suggesting lower prices. Our theory is that if we are trading in sync with that entire time frame, our open should be very close to the high of the day, and the close should be on the lower end of the day. So we start a new day in here on New York time frame, midnight. But you also have to factor, and I should have said this earlier, but new day, GMT time, okay? So here's the high basically for the day. But in terms of the way I trade, I use this as my day here. But you got to go back and reference, okay? Because here you can see the optimal trade entry pattern here. They got you, selling into London Open, okay, which is fine. We'll take that into account. But using the midnight time frame starting our London session, okay, now we can use optimal trade entry for direction to get in sync with the day. You're going to go short in here. We stabbed above it just a little bit in here, but stops are 10 pips above here. So we're looking at basically 145.10 would have been a good number in here to go short. I'm sorry, put a stop in here on a short. Okay, and then price trades down, starts to consolidate, and we get more consolidation going into New York Open. Again, same premise in mind. We believe that the high was put in for the day. So when we see this high make this low and it starts to trade up from it, in other words, your chart would look like this. Okay, you would be going short right in here, which happens to be right at the 144.80 level. All right, and by doing that, you catch basically this move in here. New York Open gets you in sync with the day's trend, and then you have the 1800 hour right in here, which is basically what? That's the lowest portion of the day. Okay, so you see how that works, guys? Anybody not understand what I just gave you? The tools are all in the notes, and I guess it really does make sense if you see it. It makes more sense, obviously, visually and walking you through it. But this is how you see me catching these monster trades, and how you can do it. You're practicing it in your demo account. I'm sorry, what mid pivot? I'm sorry. Let me go back. That would be mid pivot MS1. Let's just draw a fib between the central pivot and S1. You'll see right there at the 50% level. And then, isn't that amazing how that unfolds like that? So that's how you trade the New York session. You get yourself in sync with the higher time frame, allow the London session to trade. So that means, guys, if you don't have a really good time frame in your global your where you live at, where you reside in the world, if London Open doesn't really work well with you, um, just sleep in and then trade the New York Open, because it allows you such a huge advantage by having, number one, you have the higher time frame giving you where your directional buy should be, higher or lower, and then waiting for the London session to put in the high or low of the day. And if it is in agreement with your trend direction on a higher time frame, you know you got 80% likelihood that the flows are going to drive lower, and all the institutions are going to put all kinds of pressure, and banks are going to put all kinds of pressure to make this thing go lower. And all you're going to do is just wait for the opportunity when time and price meet New York Open, and just get in there and do it. I mean, think about it, guys. I mean, here's a trade using optimal trade entry. Okay, because here's the swing going into New York Open. Okay, you're going to risk. Now watch this. This is what should be jumping off at you. All right, here is a trade that you're going to risk less than, good grief, less than 30 pips. Now, even if you get first profit from this low to your entry, you're risking 30 to make 44 pips first profit. Okay? You haven't even fulfilled the average daily range yet. Look where we're at. And all of a sudden, boom, it falls off the table. Now let's use our swing projection. Okay. Here's 261 extension. Went down below that, worked this level, and we ultimately got down to S2 for the day. And that to me that's awesome. I mean, that's huge. So if you took first profit here, use double tap and let it run the rest of the day into the close, 1800 hours for the day, which I'll put that on the chart so you can see it. Right there is where you're getting out at. What else did you leave on the table? Nothing. So that is my treatise on the New York Open. There's a lot more to it, guys. I'm just giving you the skeleton behind it, how you can immediately start implementing it and looking at it. And you can see now, go back to all the Pro Traders videos, and you'll see how I did it. So I'll give you a few moments if you want to give me some questions about this, and I ask you just to really keep it focused on this tonight. I know there's other things you may want to ask me, but we can do it after we close the video. Any questions on what we covered tonight? Okay, I'll give you another minute or two in case you're still typing. We had a pretty good turnout tonight. That's pretty good. I'm glad you guys came out. For pivot zone trades, you want 40 pips. Okay, when you're trading, trend trading, okay, it doesn't matter because you're going to see things that's higher than 40 pips. $1,800 is your exit ramp for the day if you're in the move and it's been profitable for you. In other words, you caught the lines portion of the day. If you have positions still on and you're not comfortable carrying it overnight or going into the weekend, you want to square your positions out and get off. Don't have any more at risk at 1,800 hours. Just put it on your charts, guys, and you'll see. I mean, you're getting just about every bit of what's on the table to take. And it's always like this. I mean, I can't make it any clearer than that. It's just something you really want to be paying attention to. Well, the reason why you want to take profit here is because, let's put that fib back up. You're looking at a potential move going lower selling it in here. Okay, so obviously trading back down. Okay, as price trades back down here, price could very easily go to this level, because now this is a known low right here. This list is a known low. So as price is trading down here, we don't know. We don't know that this is going to not provide resistance. I'm sorry, support. And then when it gets down here, it goes back higher. You don't know that. And this is my premise in teaching you guys. You don't have to be right and still be profitable. You're making about 40 pips of a move here from selling here, getting down to this low here, taking off a portion. If you use double tap, take half off, put your stop at break even, and let the rest of the remaining position run into the close. If you are like me, sometimes I will take 30% off here and let 70% run if I'm in direction of the higher time frames. But you really want to take profit at 20 pips, 25 pips. Certainly, I yell at everybody that never takes profit at 30 at least. If you get 30 pips in a trade, take some off. I don't care what it is. Take some of it off. And if you do that, it'll help you cover costs on trades that you're going to eventually lose on. So if you take little bites of that elephant, eventually you'll devour it. Does that make sense, guys? Yeah, I got to do a lot of editing, so it may not go up tonight, but it'll go up. I would expect the high or low. I would expect the high or low for the day to be put in place certainly by um, 9 a.m. GMT time. So if it, 9, it's a huge, yeah, it's a huge uh, odds that it's making the high or low of the day before, certainly before 5 a.m. New York time. Let's just say that. But most of the time it's before 4 a.m. New York time, and certainly between 2 a.m. and 4 a.m. for me. I see it a lot, but it will have definitely the higher low in before New York Open, and that's all it really boils down to. That was what our teaching is tonight. Looking at New York Open, how we can get a high odds potential trade several times a week. And hopefully this is what you get out of all this is you don't have to trade every single day. You just wait for everything to line up with the higher time frames and nail it. I mean, just kill it. And when you get it, milk it. But I'm going to close here, guys, and I thank you for coming and being a part of it.